Five. All right. Welcome, folks. My name is Ben Packard, and I am thrilled to be here for the first week of our 497B, for those of you taking the one credit, and 495D. Do I have that right?
495.
Close enough. The sustainable business class. We have, as we know, a series of speakers as we move through this journey of talking about business generally, talking about sustainable business ideas and frameworks, and then talking about the application of looking at critically what makes a business sustainable. And we're going to get zero in on this as we go through the course of this quarter with speakers that are going to increasingly focus on climate and their work on climate as a proxy for assessing their sustainability strategies and how sustainable they really are, or their sectors really are. So to start us off, I thought we'd invite a colleague of ours from the Foster School of Business, Charlie Donovan, who's with us here today. Charlie's on a two-year appointment at the Foster School of Business, has a really interesting background. I'll let him tell his story, but I hope you'll join me in welcoming and thanking Charlie for joining us for our first week here.
Hello. How are y'all doing? Yeah, good. Well, so Ben asked me to come and spend 45, 50 minutes with you. Hope that we can talk about a number of things. And I hope that in some ways give you some insight into what the role of business is in this journey towards sustainability or towards climate stabilization or towards whatever you've kind of in your own career path is that impact that you're trying to have. You're going to interact with business, that's for sure. And you might kind of go into it with some different impressions. You know, business is bad, business is good, you make a lot of money, you don't get control of your life. How many people have already worked in their lives, have done something, and anybody worked for a business, like a big, yeah? And anybody worked for a big corporation? Yeah, where did you work? Where have you worked?
Isuzu Motors.
Isuzu Motors.
Back when they still made passenger vehicles.
Okay, great. And what did you do there?
Purchasing.
Purchasing. Okay, so all supply chain stuff, that kind of thing. Good. Who else worked for big corporation? Yeah. Starbucks. Okay, and what did you do there?
Barista, baker.
Okay.
Yep.
So you got in on that ground floor.
Yep.
Yeah. Okay, cool. Who else? Yeah.
I work at Alden's.
Which is?
It's a shoe company.
Okay. And what did you do there?
I sell their shoes.
Okay, cool. Great. Front line of how that company makes money, right? Doesn't work without that. How many people would think that they want to go to work for a company when they're after the degree that you're doing? Smattering. Okay. And what else? What else coming out of this degree that you're doing, or why you're undertaking this piece of education? What are the other things that one might like to do? You'd work for government? Is that a possibility? Who would like to work for government? A little bit. Okay, good. What else is there out there? There's business, there's government. If you'd like to teach, I don't know, we'll see. Nonprofits. Okay, so that would be more talking about our World Wildlife Fund, talking about these kind of things. Okay, it's a very interesting route to impact. What else? Yeah, research. And where would you do that research? Anywhere. Okay, so you want to get in, you want to like play with data, you want to really come out with evidence. Yeah, cool. Okay. So I've been really fortunate in my career. I've been a chance to do all those things. And I'm still trying to figure out what I'd want to do when I grow up, kind of thing, you know? So I just to tell you about myself so you understand where I'm coming from. So I went to this fine university. I did an undergraduate degree here and graduated in 1995. Okay. And I thought for sure, I would just move to New York and like make it big on Wall Street. That was like my thing. I don't know how I got this idea. Well, I do know how I got the idea. I started working. One of the great things about a state education or public education is that you have the chance to organize your life, and you're near So I worked for a brokerage firm when I was going through college. And I would wake up really early and I'd go down there and I had my hair slicked back and I was, wearing a tie and I felt really, I was betting on basketball games on the side, and it was like 19-year-old high roller. And, that was my first iteration. When I look at myself there, I can see that there's still some aspects of that, of me and that, but there was this like supercharged kind of sense that like business was about, making money. And it was about the thrill of I'm going to win and you're going to lose, right? And there's still I still see that in a lot of ways. Finance as an area, which I'm now a professor of finance, is quite different. It's much more research and it's much more actually kind of boring, I have to say, in some ways. Okay. But it's totally a polar opposite from that other environment, which is I really don't care intellectually about anything that you're saying. I'm just trying to figure out, can I make money of? Okay. And fortunately, when I kind of came out of school, I had a little chance to did some traveling and had a chance to pause. And before I was going to go make it big, I thought, well, that's because it's going to be a long road. I might as well go enjoy myself now. And fortunately, in those experiences, kind of had a chance to think like, geez, I don't know, maybe the world's a bit bigger than that. So I moved to Washington, D.C., slept on somebody's couch. And I had and just went out there and said, this is what I want to do. I want to get involved in environmental challenges. I'd done an internship with the Sierra Club, so I had always had this other aspect that was running alongside, but I sort of treated it as my pet project. And I thought, well, the traditional kind of American mindset. Well, I'll just make a few billion, and then I'll get back into what it is I really want to do. So I moved to DC. And I worked for the U.S. Environmental Protection Agency. I was really fortunate to get a job there. Not extremely qualified, I'd have to say, for that job. So that was a lucky break for me. And I got acquainted to this topic called climate change. And there was suddenly an opening for somebody to support the Office of Policy within the U.S. Environmental Protection Agency, which was working on a thing called the Kyoto Protocol. I had never heard of the Kyoto Protocol. I didn't even know where Kyoto was, but I thought, well, this sounds pretty interesting. I'll give it a best shot. So I tell you this because there was an inflection point there. And I think in a lot of ways, if I think about the rest of my career, which I went on, I went to business school and then I came out and started to work for the energy industry, worked in management consulting. There was all these points of kind of inflection where something, you have a sense of what it is that you're going to do. And then you give yourself just enough of a pause or just enough of some new experience. And it kind of, gives you that moment where you understand that, wow, maybe I can incorporate this, but join it with that. And that would be more satisfying. And so for me, with that journey has been about kind of weaving together that interest in public policy. I'm always still really interested in that. Politics, maybe not as much as policy. For those of you that know that space, you kind of know the difference there. Always that interest in finance and the daily action that happens when you're trading. It's really exciting. It's really nerve-wracking, but it's really exciting. That's why a lot of people who work in that industry, they drink too much, they smoke too much, they do, because there's a constant adrenaline rush that people get kind of a little bit addicted to. That somehow, what I decide right now is going to really matter. And that's something that for some people it feels great. Kind of makes them feel alive. Some people, it's like, oof, worst thing you'd ever want to have to do is, constantly be making those decisions all day. So there's one part of what I do, which is still, I like that. That's why I think I probably still work in coming into academia, I always gravitated towards finance because it still had that component to it. And there's the part of research, which is somehow continues to have more of an intellectual journey. So if I think about where I am today, I'm content that that weaving has happened, a lot of different strands of interest. And so as we get into this conversation today about business, we just encourage you to think about, is this a strand that would fit in? It doesn't have to be necessarily that you would want to do, but the awareness of some of the basic principles of what goes on in business and what governs the relationships, let's say in finance or in the capital markets, is almost inevitably something that you're going to have to deal with. And if you could incorporate that even just a little bit, even if you just hate it, I can't stand that. Just some basic language and awareness of what's going on there could be a real boost to you, because it could give you some more credibility to, interact with folks and use a language of finance that is can be really confusing You know, so how many people would say like they read the Wall Street Journal on a daily basis? Nobody. Yeah, wait a little bit. Okay. Okay. The Economist. Who reads the Economist? Anybody read the Economist? Ben reads the Economist. It's pretty kind of expensive to get. I steal it out of my colleague's cubbyhole every Friday because he doesn't seem to read it. Okay. So if you pick up the Wall Street Journal, you pick up the Economist. A lot of people feel a little bit intimidated about reading that stuff. Why? Because there's a lot of lingo. There's a lot of acronyms. There's a lot of kind of slang in a lot of ways. And for those people who are really into economics or finance, and my area of study is financial economics. So that's I can tell you that we've done that purposely. We've done that purposely because it creates this barrier to entry. That way that we don't really, we know what we're talking about, but you don't know what we're talking about. And therefore you perceive that we know something that you don't. So my hope in this next, 20 minutes actually is to a little bit demystify and just talk about some of the basic building blocks of what goes on in a business, what goes on amongst investors. That might give you some indication that it's like the emperor doesn't have a lot of clothes, might have a little bit of clothes, but not a lot of clothes. And it's something that if you wanted to get more awareness and incorporate into this journey that you're on for your own purposes, it's not that hard. It's not a huge mountain to climb. Okay, so I just, in the next kind of 20 minutes, give you a couple building blocks to think about that might, spark some interest, areas of inquiry that you can start to wrap into what it is that you really want to do. Okay, so let's ask I want to ask you some basic questions. What's a business? What is a business? How would you define, how would you say what that is? What is a business? Yeah.
I mean, in the most basic sense,
Yeah.
I would say a place that sells things.
Okay, so there's something about that it sells things, okay? And it probably has to buy some things too, okay? What else?
Primary goal is to make money.
Okay, so that's an interesting one, okay? Because the objective, we assume, is something about making money. And so we would say maybe, the objective is to make a profit. That's a controversial one. Yes, it's a very controversial one because in some ways that's true. We see, these are not charities. These are not charities. But is that their only function? Is that why we give them a right to exist? Because in some way we could just think about these are just legal entities. To do is we'd have to write some articles of incorporation that says what we're going to do. And then we take it to the state and they give it a stamp. And they say, you're a business. In fact, you could set it up online and tomorrow you could have a LLC, which is a form of a business. So at its very most basic thing, it's just a legal entity that is just recognized that it undertakes transactions, it undertakes exchanges, it buys and it sells. This whole layer that you're mentioning here about what its objective is actually entirely dependent upon how it's incorporated. So to the degree that you set up a C Corp or an S Corp and you put it in Delaware, which is where for some bizarre reason, a lot of companies in this country are incorporated, then it's pretty much presumed that that's what you're trying to do with your company, is to make a profit. And the sort of the hyper extension of that is that you now have a fiduciary responsibility. You have a legal obligation to maximize wealth for the people that invest in this business. But that doesn't have to be the case. So we have examples of things like B Corps, which is kind of a recent innovation. So given this pressure and people are saying, well, hey, I want to set up a business because I need a legal entity. We're going to end up buying and selling things. But it's not because we're just trying to make, as much money as possible. We have a social impact that we're trying to do, or we have an environmental objective we're trying to achieve. So as of today, you can actually set up a different kind of corporation that right there in the documents, you say, this is what we're doing. And if you don't like that, then certainly, please, don't invest in us. So the very starting point is about a legal entity that does undertake some commerce, some transactions. And the question, just keep suspended for a minute, is about what's the subjective function. So now if I change the question, because a business needs money to start. Imagine you just want to start your own business, or I had a lemonade stand when I was a kid. Okay, where did that work? We could think of it in a sophisticated way as I needed capital. I got to buy some lemons. I got to get that sugar. I got to get water. You know that we don't even have chairs. Okay, I need all that. That becomes in a business thinking. That becomes the capital that I need. So where would I go? Where do I go for that capital? I could, but I was 7 years old, so that wasn't necessarily, it wasn't kind of, it wasn't quite ready for the bank interview at that stage. So, but there was a bank that was open at that stage, and that's the bank of mom and dad, right? But you could think of it, it's kind of a silly example, but you could think of it as that, like, those were my investors. So I say, I need $5 to buy a bunch of lemons. And so if we were to ask the question, what's an investor? Then it's really anybody who's in the position to provide those resources. And capital, money is one kind of resource. They could have gone out and they could have bought the lemons for me. Yeah. And they would have said, okay, Charlie, this is really great. We'll really love to see it. But we're going to be taking a 25% lien on all of those profits that you make from these lemonades. That would be a very simple kind of transaction that we could undertake, and it would make mom and dad the investor in this business. But if I was trying to set up a professional thing, like I want to be the world's leading lemonade company, okay, that's a little bit different. Mom and dad are going to get tapped out pretty quick. So then what's an investor? So you're saying at a bank, and what does a bank do? How does a bank help me? Okay. So they're going to give me the money, and they're going to do that by lending it to me. Okay. So this is a really kind of important distinction. I'm just going to put the D up here for a second. And we'll figure out in a moment what that coding is all about. Okay. So banks, who else could be an investor in our world leading lemonade company? Who else could we go to? We could go get a loan from a bank. They become an investor in some ways. Yeah.
Another company, like a private equity company that wants to put money in exchange for it.
Okay, great. So we could think of these private equity fund. Who are these people? Like, do you have a name? Can you think of a brand name around a private equity fund that might invest in a lemonade company?
Well, I can't think of the name right now, like on the top of my head, but I have like an idea of what these people do, people that want to make money from investing in like smaller businesses, and then their share appreciates in value as the business grows.
Great, perfect. Okay, so we're talking about, but the reason I ask you about could you name one is because they're really hard to name. These are not brand names. We don't really know who these people are. It's like, that's the shadowy world of private equity. They don't have, there are some bigger names, KKR, there's been books written about, but by and large, these are not household names. This is not Starbucks. But there's a whole universe out there of people who have pooled money into these funds. And here we're talking about billions of dollars. And if you got a really big idea, and some of them specialize at the smaller end, they would be willing to put money into that business in return for ownership in this venture. So now I'm going to put an E over here, and we'll come back again to decode that in a minute. What else? Who else? Who else could be an investor? What's a type of investor? Yes.
I'm not so sure, but I think every person could be an investor. Like if you're buying a stock, it's kind of investing.
So who would that be that's buying the stock?
Like every person, like as long as we have money, we can invest everything.
Yes, absolutely. Well done. So that would be what we call retail investors. That's you, me, and everybody else. That's how we could crowdfund this business, right? And we just say, hey, in fact, we could use the rest of this time for me to pitch you on this lemonade company. And when we walk out of here, I'll make you the idea that just for $100, you can become a shareholder in this explosive hypergrowth lemonade venture. So very, very possible. Okay. And again, they're going to get an E in my, who else? Investors. Yes.
Could you say
You could say government. You could definitely say government. And governments invest in things all the time. They're very tricky for my E and D. They're super tricky to figure out. Okay, but absolutely, governments can be investors, and they would do that all. Now, to get a government to be an investor in our lemonade venture, we're probably going to have to prove out something pretty special. Like, I don't know, we're using lemons that are grown in a magic hillside that needs to be, we're going to have some super big impact, because it's not usually the government's job to invest in just your average lemonade company. But to the degree that we can, maybe through a grant or maybe through a low-cost loan, we can find examples where that's going to work. Who else? This is a good list. Corporations can be investors. Are there big investors? Okay. They tend to be on the E. There's a whole class of investors called institutional investors. These are things like pension funds, insurance companies, sovereign wealth funds that have usually collected money, and actually in some ways from you and I, okay, because that pension fund, that's my money, but I've handed it over to them involuntarily in order for them to invest so that I can have hopefully a nice retirement. So even though this is kind of like a laundry list, if we had more time, we could start to think about actually the flows of this, because it actually all starts kind of upstream with you and me, because that's who funds the government, and that's who funds a lot of this. When I go to, how does the bank have money? Well, they have money because they have depositors. That's you and me. How does institutional investor like a pension fund? Because I've given them money out of my paycheck every month in order to manage that. So the E and the, who can guess here what the E and the D represent? We could play hangman on the other side here. Yeah?
E for equity, D for debt.
Hey, we're on to it. Okay, so E for equity and D for debt. Now, this is like, if you have this in your mind of how investment works, and you go off that top line and you come to, well, there's two forms of investing, really. Everything is either equity or debt. That's already like quite a powerful insight. Why? Because it takes all of the big messiness out of it and says there's only really two ways to do this. There's one way to do this, which is a fixed obligation, in which when the bank comes, let's use a house, okay? Let's think a house is a nice way to do this. When you invest in a house, you're an investor and you want to invest in a house. You got nice picket fence out in front, you got the windows here, you got Fido down the dog, you got 2.2 kids inside the building. It's beautiful. Okay, you're really happy about that. So you want to buy a house. Money for the house. How do you get the money for the house? You got to save, right? You got to save. But, the way things are going, it's going to be a long time before you're going to save the kind of money that's required in order to buy a house. So it occurs to you the bright idea, you know what, how about I could go to the bank? They got these things called mortgages. I could get the bank to help me out. So what the bank provides is called debt, is the debt capital. Okay. And they might even give you up to like 80% of that for debt. And then the remaining 20% has to be equity. So why do I go for the mortgage? Well, I go for the mortgage, one, because I don't have the money. But imagine you had the money. Imagine you had $1 million. Why would you still go for the debt? Why would you still go for a loan? How is it in your interest to still borrow money, even in the case where you actually have the money?
Tax write-off.
Could be. Okay, so taxes are a big issue. Taxes are a big issue. Maybe less for this. They've just kind of closed that down for houses, but certainly when businesses think about buying plant, machinery, equipment, interest is a deduction that gives them some tax benefit. What else? Yeah. That's the big one. Okay, that's what we think of as the opportunity cost of capital. I can do something else with it. And in fact, if I had $1 million and I spent it all on this house, traditional finance would tell you you're making a mistake. even though it's probably it's the safest thing for you to do, because then you don't own money to the bank. That's nice, makes me feel good. But you don't have any diversification. Everything is now on this house. And imagine that, I mean, it doesn't seem very likely now, but imagine Seattle goes through a rough patch. And then you want to move to Texas and all of your wealth was stuck in this house. Well, it's not going to be so pretty. So the idea would be, well, even if I had the money, I'd much rather just put 20% of it down, because then it frees up the remaining 80% in order to do something else. And something else could be I invest in stocks, I invest in bonds, I invest in cryptocurrency, I invest in, I don't know, whatever you want to invest in. The other reason, but that really is connected to the opportunity cost, is that the rate of return becomes really important. How much financial return should you expect on buying a house? Not many people make that kind of like explicit. I mean, we all think that it's going to be great. You know, house price is always going to go up. But it's not so often that people think I have an exact sort of measure of what return I'm expecting. But what you do know, because that's almost impossible to tell. And for businesses, it's very hard to tell too. If you were to continue into, a class that I would teach around corporate finance, we'd talk a lot about how a company creates its own expectation of how much return it should expect when it invests. It's like a very dark art. Okay. But for you, when you come to making a big decision like this, you're going to have the same problem. You don't know exactly. I mean, it's kind of like, well, I want to get what everybody else gets, What you can know for sure is what the rate of the cost is going to be of using debt capital in the form of a mortgage in order to make that happen. Why? Because it's on a piece of paper. When you go to sign the thing, they're going to tell you exactly what the interest rate is that you need to pay, and you're going to be paying that out every month. Yeah. And in principle, you love using that loan, because your rate of return, the thing that you want to achieve as the owner, as the equity holder, is always higher than the debt. Always higher. Why is that? Anybody know why that is? Why can I just say that with absolute certainty that the rate of return that I would expect on buying a house is higher than the rate of interest that the bank is going to charge me? How do I know that for certain? Yeah.
The interest is kind of dependent on what the economy does that affects your return.
Okay, good. And then so that makes you so how does that shape this fundamental ordering of the return between that I have to pay on my mortgage versus the return I expect when I come to sell the house? No, it's good effort. I mean, you're super close. Okay. What happens is that you have a situation in which there's only two. I mean, there's thousands of flavors of ice cream, and there's thousands of different types of ways to invest. But fundamentally, they all boil down to one of these two. And the way that I know that this expectation of return as me as the owner is higher than it is for the bank is because if things go wrong, the bank has a lot more security than I do, because they have a legally enforceable contract that says I will pay that interest every month. And if I don't, what do they get? They get the house. They get to take that house right away from me. And so what this does, no matter whether it's a house or a factory or a wind farm or whatever, the two types of investors, a debt investor and an equity investor, have fundamentally different rights with respect to whatever that thing is that we're trying to accomplish. Fundamentally different. Different in two ways. One is the security. Okay, I own it, but if I miss my debt payments, you get it. That's kind of weird. It's like it was mine, and now it's not mine anymore. But the other thing that's very interesting about it is that if in bankruptcy, if this event occurs, the order in which somebody gets paid is different. So I go bankrupt with that. I go bankrupt personally. The house then becomes theirs. But actually, if you think about a slightly more complex situation, so I worked for a company called Enron. Anybody ever heard of Enron? That's good. I love it. Now I'm really happy when people don't know about Enron. Okay. It's like shaking their head. No. Perfect. Okay. Should just leave it there. Okay. Enron was a big company, one of America's top 10 biggest companies, most innovative company 5 years in a row, just the kind of place you want to go. And it went spectacularly bankrupt in a big accounting scandal. There's a book, there's a movie, there's a whole thing. And the reason I bring up Enron now is because Enron went bankrupt. And when Enron went bankrupt, I was left out. I went to work on Friday, and they said things are looking bad. And I'm like, okay, call me on the weekend. And his boss calls you on the weekend and says, don't come back. You can't come back. It's over. So immediately there on a Monday, I'm out. Enron's gone bankrupt, and I have a relationship to Enron, and I need to recover from in a few different perspectives. I was an employee. I have a claim for the month of salary that they were no longer going to pay me. I was a creditor to the company. I had loaned them money in the form of traveling on expenses, paying for it myself, and they hadn't yet reimbursed me. And I was also a shareholder. I owned Enron stock. So imagine that we're all going to, we're going to the courthouse, and we're all going there to figure out who's going to get some money, because there's still some money left. When a company goes bankrupt, it just technically means that they have more obligations than they have assets to pay it. But it does not mean they have nothing. And so then a court comes in and figures out who gets paid. So who gets paid first? Who would you imagine at the courthouse? Who's at the front of that line? Who gets paid first? Yeah. Yeah. Unfortunately, they do an end around. That's like that's in the alley. That's what's happening in the alley. At the front of the building, the executives are way out there. Like, come close. Okay, they got the tape that says no, nobody. Who else? Who else could have that? Who else could be in a position they say, I'm here first. I get the money. Whatever's left over now, I get it. Yes. Absolutely last in line. Absolutely last in line. Now you would think, the executives and the shareholders are like, they're in there just cooking it around. But actually the first person that gets there is a representative of the government. Says, okay, throws the elbow, said, back off here. I've got back taxes to be paid on corporation, sales tax, whatever it is. And you guys just take it easy. And when we're done, I'll let you know if there's anything left. Okay. Then depending upon what country you're in, because this changes a lot due to different countries, it could be that your suppliers are next in line. Could be that your employees are next in line. It could be a lot of things. But you would have to get all of those people sorted out before you come to your shareholders. They're actually the last in line. And the people who are just in line, ahead of line in them, are the creditors, are the people who have lent money, because they have a secure claim. They have a claim on the assets of the firm that's written down and says, you were going to do this, you failed to do so, and so you get a priority. So that's why I know that as an equity holder, as a shareholder, as an owner, all of that, I'm saying the same thing in 3 different ways. I must need a higher rate of return, because in the flip situation where things go bad, I'm the last to get paid. Therefore, we start to encounter this fundamental relationship between risk and return. And the line, and it goes like this, meaning that every time I take on some additional exposure to risk, you've got to compensate me with some form of return. Okay, here we're probably talking about financial return, but we could extend the analogy to almost any source of return: social return, environmental return, whatever that is. So in a lot of ways, in one way that I suppose I'm starting to propose to you now, what is a business? A business is something that manages investments along a risk and return continuum. That's fundamentally what they've got to do. They've got to find out, how do we take money that people have placed with us, either we've gotten it from the bank or we went out to shareholders, and how do we deploy that in a way that sort of observes what the world considers to be a fair trade-off between risk and return. if we can get more return with very little risk, great stuff. People like that. If we get more risk and less return, not so good. And so while there are all sorts of people doing all sorts of things out there in the world that are all around, in principle, we tend to think that over time, it's kind of converging around that stylized relationship. That means that the more risk you take on, the more expected return you should get. Do you always get it? No. But your expectation is higher. It moves higher. So how does this connect to things like climate change? Well, in a lot of ways, it's because we need massive investments in order to do something about climate. We're probably beyond a point. I think maybe when I first came into awareness about these issues and working on it, it seemed to me that like the thing that we had to do was reduce everything. And increasingly, as I spend more time in the job that I do, it's actually we have to increase everything, because there's no way in which we can survive as a human species without some of the basic needs that we have. We need water, we need food, we need energy. And when we stop investing, actually, ironically, what happens is that we continue to use the old systems, which tend to be more polluting systems. And so to get where we need to be, which is a reduction in carbon emissions, reduction in resource intensity, reduction in water use, we actually need to invest a lot more, because we got to take out those old systems and put in some new ones. Now that begins a bit sort of self-reinforcing to the capitalist system. It's sort of like, it's kind of pat ourselves on the back that like the way to save the world is to somehow invest more. But I don't see any other way out of it. Look at what happened in COVID. The first 2020, COVID happens, everything hits the wall, carbon emissions went down pretty substantially, but not as substantially as you would have thought. It was like 7%. I mean, we're all sitting at home, doing the thing, but it's yet still 93 units of 100 are still being used and being emitted. Why is that? Well, because it seems that there's so much embodied carbon in what we eat. Our homes had to be heated. Apparently, they still had to keep all the lights and heat on in these skyscrapers. I'm not sure why, but. So for me, that was, I think I sort of knew this, but it was seeing those numbers. And then, of course, in the recovery now, what carbon emissions went back up by 6% last year. And we were no better off. So it sort of drilled down to me that, geez, even if we just stopped, nobody would have ever thought that we would run an experiment like that. But if we just stop, we actually don't solve that much of the problem. Nobody's driving, nobody's flying, yet still we're at 93% of our previous footprint. So this is why, for me, and I guess as a suggestion to you, and I'll stop here and just ask if there's kind of general questions, but some of these concepts about debt, equity, risk, return, investors, who they are, become more interesting purely from an environmental perspective, because because the game begins to be, at least in the suggestion I'm putting forward to you tonight, is that we have got to hyper invest now in order to take out all of that infrastructure that we had before and put it in that's something that's better. And unfortunately, we're in a situation right now in which we're reinvesting, but we're reinvesting in the old stuff again. That's not going to get us there. And so one of the big public policy questions is, what are the kind of interventions that would not force people necessarily, we don't live in that kind of economy in the US, but that would put in place the right incentives so that we get more of the right kinds of investments, accelerate that, and find that we can actually get to where we want to be on some of these great challenges. But it becomes public policy becomes starting to morph much more towards investment policy than maybe that kind of command, control, regulation that's been a feature of the way that we've solved a lot of other environmental challenges. So I'll stop there. Happy to take questions, but I hope just as one kind of insight in terms of what business does, what investors do, is that it's something that actually ultimately is meant to serve us as people. And to the degree that you understand some of these mechanics and some of these relationships, maybe it can make you more effective in advocating for the kind of policies that would mean that we do more of the good stuff and less of the bad. Okay, yes,
Can
Ben.
I provoke you on the reading that you gave us?
Sure.
We talked earlier in advance of this about who Larry think is,
Yep.
who he's writing to, what he's asking them to do.
Uh-huh.
Can you bring that back to the equity investors?
Mhm.
Speaking to why there might not be important?
Yep, great, thank you. So Larry Fink runs this firm called BlackRock. They manage on behalf of investors $10 trillion. So fairly systemically important financial institution. And the reason I asked Ben to send you around that piece is because this was, when he wrote that letter, it was a shockwave in a lot of ways. Because what people were trying to continue to do is to run with an idea that risk, return, debt, equity, making money, and the environment were two separate kind of considerations. Back to a little bit back to the dichotomy that I set out for you at the beginning, that I'm just going to make a lot of money and then I'll try and help the world. And what Larry's letter did was say that actually, you can do that. That's fine. But what I'm telling you as the CEO of a $10 trillion asset manager is that we're convinced that climate change is an investment risk, is a financial risk, meaning that it's shaping risk and return going forward, meaning that it's no longer like this side thing that you do. It's something that we need you to start to tell us about what your emissions are, what's your transition plan, not because we've suddenly woken up and we feel like we want to save the earth, but because we're convinced that this now becomes part of the fabric of what investing is all about. And as the world's biggest investor, you're going to have to start to tell us some stuff. So it was a big, I guess that had been brewing for quite a while, but it was this tipping point, and people still refer to that letter. And I wanted you to be aware of it because it's felt like a moment in history at which we said, okay, we can continue to have, as people who work in financial markets, we should continue to have a great concern about these issues. But now it becomes part of our day job too, as enlightened self-interest, knowing that where I'm going to be seeking returns in the future is going to be shaped by this. And so the more that you know about that, the more that you tell me as a company, the better informed we are. And this is going to start to affect our decisions. And that hasn't been a feature, I would say, for a long time of how mainstream thinking about those issues has been evolving. Yes.
I had a question about investments in the environment and in climate change. So you mentioned, from what I gathered, it's not a very common or popular practice, I guess, as of this moment.
Mm-hmm.
And what I was wondering is, could you mention providing incentives for these kinds of investments? What kind of incentives would you propose would make people more prone or more encouraged to invest?
Great question. So I'm not sure the obvious first issue is that we can no longer allow the externality of carbon emissions to be paid by you all in terms of your future ability to be prosperous. So there's an economic externality, which is that somebody is profiting while somebody else is paying. So let's just take BP. I worked for BP, so I'm turning the knife on myself here, but we're benefiting, and then you're going to pay to deal with the problem. So that's an economic externality, and you have to fix that. So that could be a carbon tax, could be forms of carbon trading. Okay, there's a whole suite of stuff there that I'm sure that you're familiar with. That's a carrot, but it's also a stick. It's probably most people think about it as a stick, but a very necessary and just economically rational. I mean, it's just beyond any debate at this point in my mind. Then in terms of incentives, how do you create? So already in the US you have, and around the world, you have a lot of incentives. So you have the tax code, unfortunately, in this country is the biggest thing that people look to in terms of incentives. So you have in wind power, you have a production tax credit. In solar, you have an investment tax credit. There's a whole kind of area of that. What I wouldn't have said before, and maybe has become more apparent, is about social pressure, which has become both a carrot and a stick. So what we saw with you guys, it didn't really happen here, but a movement called Extinction Rebellion in the UK. Really fascinating to see how that played out. Definitely for good and for bad, changed impressions. But we're definitely in what is a much stronger social movement now. And that creates, why is that an incentive? Because certain companies can find that they align towards that. Now, those are sustainability leaders already. There's your Patagonias, there's folks like that who have already found that if they can orient themselves in an appropriate way, they're going to be fine. What we have, though, is a huge long tail of no-name companies out there producing, any product. I mean, where does that plastic come from? How does anybody really know? So in my own mind, there are incentives, there are opportunities, but we can't really just kind of try to paint a pretty picture on all of this. It's some of a big part of the solution is getting people to pay the proper cost of the production of the products and services that they provide. And the fact that they don't today has a historical legacy, and that's why it's so hard, is because we're coming from a place in which we perceived that the environment, mostly in natural resources, were just kind of a free gift that we would just use as much of. But when you get into a mode of thinking about business in which the economy is nested within the environment, well, that's a totally different setup. So I don't know if that's perfectly answering your question, but yeah, okay, good. I'm glad. Yes.
Yeah. So you talked about Larry Fink's letter to CEOs, and in that letter, he talks extensively about accountability and transparency in investments and business practices about environmental sustainability. However, then later, in doing some research, if you look at BlackRock holding from 2020 all the way till now, they've only dropped 0.03% in Exxon, 0% in Chevron, and multiple high energy, high polluting companies, as well as in 2021, they blocked, or not blocked, but voted against the disclosure of environmental expenditure.
Yep.
So I guess in my mind, sort of connecting back to your most recent point you were making about hyper investments, why should we be investing in these companies if continually, even companies that are showing they're aware of a problem are not changing? How does hyperinvestment change anything in that case if at the end of the day, no new technologies are researched and all the money goes back into the pockets of the CEOs?
Yep. Great. Really well said. So BlackRock's full of it. I mean, let's be clear about that. Just because Larry writes this letter, it doesn't mean that they've figured it out how to deal with this problem within BlackRock. So we could say, in one sense, well, this is just greenwashing. This is just Larry Fink, saying whatever he wants to say because he's kind of checking the boxes. The one thing so that's one possibility. It's a very real possibility. The other possibility is that BlackRock as an institution, as the entire economy, needs to transition and doesn't really know how to do it yet. Doesn't really know how to do it. And in a lot of ways, the Ukraine crisis that we're seeing is kind of putting all that back into focus, because here we are now, we're freaked out again about energy costs, really basic things. And of course, you can recognize that in yourself. When something goes bad, it's like you fall back on, what do you know? This is not the point where I'm going to go out and experiment. So of course, the rhetoric is changing now back again towards, well, I don't know, don't we need more fossil fuels? And shouldn't we be getting more from the US oil and gas than from Russian oil and gas? So I only say that because this is an evolving concept. How good is good enough? How fast is fast enough? How much should we be expecting? And clearly, and BlackRock has taken it really on the chin, there have been plenty of situations in which now they're voting against, resolutions, which you would think that their whole policy would be aligned to. So there's huge contradictions in that. There's huge contradictions in companies, like Apple or Google, or there's a gentleman that we had on campus recently that's been highlighting how much they spend. They say this, and then their lobbyists in Washington, D.C. are arguing exactly for the other thing. So, I feel, I'm not to apologize for that, but I think that the only insight that maybe I could give you is that they're on a journey in which they're interacting with the reality. They're in a cage in some ways. They're in a cage. We're all in a cage that's somehow in shaped by the sort of external environment. And they are trying to go in one direction, but even the CEO doesn't have, in some ways, enough power to make that happen. Nobody's got enough power to pull magic lever that says this is all going to sort of change overnight. So they've got a lot of work to do. But the only thing I would maybe just, I agree with the premise, but just to know that the story now is about a transformational journey for a lot of companies. And the company that I used to work for, BP, Bernard Looney, now the CEO, I left BP because they started ditching all the investments that we were making. And it was like, well, and here we are 15 years later, and they're doing the exact same thing. And I think this time is different, but it's impossible to know. And why is it impossible to know? Because it's shaped by the market and political context that actually those individuals don't control. So they've got a lot of work to do. BlackRock's got a ton of work to do to get its own house in order. But I think we can, at least I can applaud that he's putting out there. He didn't have to do that. To put out publicly that this is the direction that we want to head. And it might take us some time to do that. And it's probably going to be a lot slower than would be correct. But even that individual doesn't have the power in a lot of ways to just make that all happen, even though the intention is there.
So sadly, we've almost come to the end of our time. It's not 7:15.
No, it's 5. It's 10 till.
10 till. And we're going to respect Charlie's time. He said he would be here for another 10 minutes or so. Bruce, I want to say thank you for bearing with us for those online. But with this, let's thank Charlie for his kind words today. So you have another 10 minutes?
Yeah, sure.
To answer questions.
No problem.
Thank you.
Great. I'll turn this off.